My personal advice would be to, it's like a health check. If you're doing nowadays everybody is doing a annual health check every 6 months. Likewise, once a year at least, we must do a business valuation and take advice from experts. They should think of it like a health diagnostic, a business diagnostic like that, likewise. So nowadays everybody is health conscious. People do their blood test and other tests every year and go for a treadmill and things like that to check their heart and sugar and everything else. So likewise, a business should do evaluation every year.
Welcome back to MSME Talk podcast for micro, small, medium enterprise businesses and startups. This is episode number 54 of MSME Talk with Vinay Pandya on how to enhance business valuation. For better experience, I would suggest you to switch to 1.25x speed and also don't miss to subscribe at the rate MSME Talk on YouTube, Apple and Spotify. In this episode, you will learn, is business valuation important for all growth stage companies? How a CFO drives real structural improvements in valuation of MSMEs and startups? Which operational and financial levers actually impact the value of businesses? Role of intangibles, working capital, and customer analysis in business valuation. Practical insights for both tech and non-tech MSMEs.
Today's guest, Vinay, has helped many startups and SME companies in the most important journey of their businesses in unlocking the value of their businesses through scaling up planning, strategic finance, mergers and acquisitions, joint ventures and partnerships, even IPO, plus strengthening their business value through the strategic advisory and CFO services. Vinay Pandya has been giving CFO services with 40 plus years of experience. A very warm welcome, Vinay, to MSME Talk podcast.
Thank you, Tripti, for inviting me, and it's a pleasure to be here.
Wonderful. So, Vinay, we would like to have a little brief intro of yours from yourself about your company, Mantraa, and your experience.
Well, as you already said, my name is Vinay Pandya. I'm a chartered accountant by qualification, but I've also taken additional qualification of company secretary, and the latest qualification which the new regulations demanded was a registered valuer, which I've taken a qualification to enhance my knowledge and also my qualification to certify valuations. I've got nearly 40 years of experience, starting with 𝐆𝐿𝐿. I joined as a trainee there, and over the period of time I grew into a CFO of one of their divisional companies, which was a joint venture with Atul Products, which is Lalbhai Group company. And later I moved to a globally competitive companies like Mitsu, which we sold to Bayer. Later on, I moved to Microwings, which was again a global company and made a big impact on its own business, scaled up from $10 million to nearly $100 million kind of revenue. And then later I joined as a group CFO of Ashok Piramal Group. And of last 8 to 10 years, I have been working as an advisor and consultant in the role of a managing partner of Mantraa Advisory Service. And I help startups, SMEs, and MSMEs to value and navigate through their journey of business and scale up, as well as various different services that we provide.
Wonderful. Very extensive experience, Vinay. And thanks a lot for joining MSME Talk podcast episode for our listeners to get into this journey and world of business valuation, which we hear day in, day out, because since last couple of years, startup conversation doesn't go without a valuation. But as in today's discussion, which we are going to have on how business valuation can enhance, or rather we can say how a business valuation can be enhanced with the help of a CFO. But before we get into that part, let's go let us step back into the basics. Like, first of all, why do we need business valuation?
Oh, well, I think the businesses don't grow by accident. They grow by intention, and we need to measure the value in order to manage it properly. And as somebody famously said, the companies which solely focus on competition will die. But those that focus on value creation will survive and thrive. And with that kind of background, if you see business value creation is done all throughout its journey, right from all the choices that we make, from manufacturing location, manufacturing size, capital, and how everything requires money ultimately, obviously. So how efficient is our capital? How efficiently are we running the business? And if we keep on measuring it properly, then the value can be assessed and then managed. So that is the purpose and the background of why business valuation is needed. Though specifically there are many instances when business valuations are also essential for certain transactions, which we can discuss later on. But finally, the business valuation reflects long-term sustainability, shareholder satisfaction, employee engagement, and several other things. So, if we see the answers which it provides to the questions to which it gives the answer, is that what is my business worth today? That can be a simple question of an owner. Or how is my value derived? What are the key drivers so that I can leverage that? Or how should I decide? What is the tool which I use to make my decisions, like outsourcing or putting up a new plant, or should I enhance my capacity, or what kind of new product should I launch, etc. Or which strategies will lead to increased valuation or value creation, and so on. So every stage there are choices and there are risks involved, and this therefore has a impact on the company's value, and it requires the valuation tool and to be valued.
Okay. When you are mentioning this particular part, for the growth of the company, measurement. So business is creating value, and we should get into the journey of measuring it, in the process of measuring it. So is it a process which is done regularly? Like, when is business valuation necessary? Let's understand this particular part. When is business valuation necessary? Is it every day, day out, or some once in a while?
Yeah, so there are two parts to this. One is that there are certain situations, of where the business valuation is utmost importance, or rather, it is central to it. For example, if there is a fundraising, there is a transaction which has to be done, or exchange of shares between the buying and selling of shares between partners or family members. ESOP scheme, for example, many companies want to attract and retain employees, so you need to do the valuation and so on. So that is very inevitable that valuation is done at that stage. But I would urge the companies not to stop at that stage. There are a lot of stages. In fact, right from the inception of the company, how you decide your strategies, how you position your company, how you position your products, what is it that you pursue ultimately is very important. And a 100 rupee profit, for example, of a particular strategy is not equal to, in terms of value, is not equal to 100 rupees profit of another strategy. Though the profit can be the same, for example, but the value will be different as it reflects into the you go down deeper into the how the profit was derived and so on.
Right.
So when the answer is at that stage, everybody must take it as a business tool rather than only a transactional tool.
Right. So you are saying basically that there are certain events where it becomes utmost necessary. You cannot work without business valuation because there's exchange of interest in the business.
Yeah.
Or they are buy-sell of the interest in the business, and valuation is one of the main mechanisms to agree on certain agreement of the price to be paid or given for that business, whether it is IPO, M&A, partnership, etc.
Right.
Okay. So Vinay, let's understand what is the fundamental problem that valuation can solve. Now, first of all, in first part, you mentioned that necessary hai, event hai, karna padega. But suppose there's no event, right? But still, valuation does solve some fundamental problems. And like, why getting valuation done making sense, even if you're not looking for immediately unlocking on event. So what is your view on that?
Yeah, see, when we do a valuation, valuation is at the end of the day, you'll just see a number that this is my value per share or for the total value of the company. But there is a lot of breakdown. If you go carefully and if you have a correct advisor and valuer, they will give you the drivers of the valuation. From where have you derived it? What is the gap there? How does it come out compared to other companies and so on? And that will give you some ideas about what can be done further in the next stage of your business and how you redesign your business, restructure your business, look at more competitive abilities, or even a simple thing that how do you maintain your competitiveness, and therefore sustainability then comes in the picture. That can you sustain your business for long, because profits and cash flow are central to a sustainability, and without that, no business can survive properly or grow even. So this is the way in which we look at the fundamental problem in valuation and what it solves. It gives you a baseline, and at the same time, it gives further guidance into what could be done next in the context of the business, of course.
Right. So basically, you're saying to derive a strategy for the sustainable growth of your business, or to align the growth of the business with your own goal or the vision by the entrepreneur or the founder or the business owner. Doing valuation brings you to the lot of areas where changes or the area of focus where effort need to be taken to intentionally do the changes. Right. So can we say a business valuation exercise is some kind of a audit for the strategy?
It's like a diagnosis report, it will give you a diagnosis report that, okay, what is your health check? If you take a report, it will tell you, okay, this is where you are, this is what, you need to do this exercise, or you need to take this new medicines and so on, or certain regimen, change of food, or whatever else that the doctors recommend. Likewise, the valuer will also recommend certain changes and thought processes to increase or enhance the valuation.
Let's link this to when you think you talk about, you have been talking a lot, right, in our earlier conversation also, enhancing the business valuation. A CFO can help in enhancing the business valuation. So let's first understand what is enhancing the business valuation, because enhancing the business valuation can also mean positive and negative understanding. Like, is it artificial creation adding on the valuation of the business, or it is something else?
Yeah. No, enhancing is about, when we say the word enhance, means obviously it is increase but also strengthen. And so it is about identifying those business drivers. And then things like, for example, what is your financial performance? How are your operating ratios? How is your capital efficiency ratios? And so on. How is your profitability? What is the kind of team that you have, for example? How it is driving those numbers? Finally, the numbers is done by the people and the assets of the company. So how are the assets utilized? What is the customer base and the customer satisfaction? Are there repeat customers? Are you able to reduce your customer acquisition cost? What is your operating efficiency? So there are many various parameters of studying that. And then, of course, it can get into things like locational advantages, scalable systems, sustainability. Nowadays, the sustainability also is a very big subject.
Right.
And so on. So these are all the things which drive a value and valuation. And therefore, using any of these drivers, we can enhance the valuation.
Okay. So by taking certain steps for those, so you're saying business valuation will give a measurement and the areas which need correction. Taking step on that, you can enhance the business valuation.
Right.
You can increase. So it is just not mean an artificially adding the numbers how to just creating a number to your valuation, but doing real actions to create the more valuation for the business. Okay. How does CFO help in enhancing the business valuation?
Let's take a quick break.
MSMEs and startups are looking for various kinds of support and upgrade. Are you a product service provider, expert, advisor, consultant, mentor for MSMEs and startups? Do reach out to MSME Talk to list your business. Check the link in the description.
So essentially, like you said at the outset, CFOs nowadays are no longer only managing the books. Books can be done easily. Nowadays there is automation and so many tools are there. So that doesn't require a very well qualified CFO or experienced CFO. But the CFO, there are two parts of this value enhancement and narration. One is the perceived valuation. If the perception is wrong, but there is an intrinsic value of the company, then you have to correct the perception. Especially in the listed companies, these things happen more often. Nowadays, there are many companies which are listed in the SME also. And so the perception versus reality, you have to correct the perception, communicate that very well. But the second part is about those levers which I just mentioned. So the CFO then identifies those levers and then pursues those low-hanging items, that these are easily done. You prioritize, obviously. Any business or company will decide to prioritize that everything cannot be done at the same time. But you can start using the low-hanging fruits, as we call it, and pursue them. And internally make a program along with the other management team and managing directors and so on to enhance those value and bring change into the company.
Okay. So, as going back to again, enhancing the business valuation is just not you're changing any numbers, right, randomly. It is basically understanding which are the numbers which is helping in the business valuation, and then seeing is there any miscommunication. Maybe when specifically you are saying in case of where publicly disclosed data is there, listed companies are there, maybe SME listed company or another big company, how others, investors, analysts are analyzing it, perceiving it. Is there some communication which is hidden but which is adding valuation to the business? So how to align that such that enhancement of the business valuation happens in the right direction? Right. Okay. What are the areas selected by CFOs to enhance the business valuation?
So we start, when we do any valuation, we start with understanding the revenue base. And vis-a-vis the marketplace, what is the share of market, for example? What kind of customers they are having, whether they are multinationals or any other such examples, And usually my approach has been to classify the market into Class A customers, Class B customers, and Class C customers.
Okay.
So Class A are the high-paying. They don't mind paying a little bit more for better service and better products. And Class B are of course the average, but Class C are the people who will always fight for the last rupee. But they are not good paymasters. They are all the weak companies.
Right.
So depending on the company's competitiveness and the product quality, you will be able to attract either A, B, or C, and the effort that you put to get those customers. So this is the first step I do. And then we start benchmarking against the competition, that how your competitors are, what are they doing, how is their revenue coming, who are their customers, who are the non-customers is another issue which I go into. And so the quality of revenue and the predictability therefore comes in the picture. Then the margin comes in the picture, that okay, if we are having this kind of revenue, what are the margins? How are you getting those margins? How is your product compared to what the customer wants or what the market demands and what the market other people are offering? And so that brings into the product mix optimization. If you have multiple products or multiple grades of product, then you look at product optimization. Then how do you look at it, and what is the current situation, and that gives a value ultimately, right? Cost structure then comes in the picture for margins, obviously, and below the direct costs, there are other overheads, how the company is being managed, what are the areas of efficiency, and so on. And then comes the capital efficiencies, that how much capital you have deployed to reach your goals so far. And all these things then will give a final value. And we also start looking at things like, do you have any IP brands which are important? Any special things that you have? You have patents and so on. And finally, we look at the capital structure, debt and equity ratios. And debt equity, how much debt is deployed, how much equity is deployed, what are the risk elements, and we weigh between the few of these, and then come to a final conclusion about value.
Okay.
So these are all the areas which we go into evaluation, and these are definitely always selected to look at how we can enhance the business valuation.
So Vinay, when you were mentioning about starting with the customers of the businesses, you first start, why did you first start with the customers of the businesses, and what kind of analysis you want to derive, and the impact which you want to, bring it into the business valuation? Yeah,
because at the heart of a value, when we say value creation or value, means what the customer is paying you, and then at what cost are you able to deliver that service or the product to the customer. And if you don't make a margin, then obviously you will not survive. So that is when how the value comes in the picture. The value is what the customer wants and is willing to pay. And then that is a main source of value. So that's where we start. We have look at the starting point. And any growth or any sustainability will come from that. And so that is when we analyze that in great detail.
So you see a mix of the customers that particular business has, and based on that, you derive one of the main components for business valuation. But tell me how the enhancement part is done with this mix which you analyze.
So once we know, what is the positioning of this particular product or customer, or rather service provider, and then what are those ABC class, how does it reflect on their own books and in the data. Then of course we have to change that, to bring it more into, for example, if they are more into C class, then their margins will be naturally low, their working capital cycles will be affected, they will be more having higher working capital cycle, etc. Whereas if they are getting, so the whole idea will therefore be to go after the A type customers. Now, is it doable? Is it achievable? And then you make a program that, okay, you take at least some B and some A. And then you have a goal next year or next to next year and figure out that how do we therefore get those customers and enhance our margin and enhance our sustainability. Right. That is the first step which we try to achieve.
Okay. So basically,
therefore it will drive many changes in the organization. When, for example, if we go to a very large customer, one of the customers, I'll give you an example also, that it is into defense. So they wanted to go in to a very large company called Bharat Electronics. Now they have a very big demand. They will ask a lot of audit questions. Operational audit, the customer will do. So the customer audit or vendor audits are very usual in many of the businesses. And so they will then, therefore, if you try to get that customer, a lot of your changes you will have to make in your quality systems, in your how you approach the customer, how you are handling the customer, how you will deliver the product, how you design and pack your products, and so on and so forth. And that itself will also drive you into better and better growth opportunities.
Okay. So now you also mentioned, Vinay, that margin, margin becomes the important part, because higher the margin or more customers, what is the matrix, helping in the business valuation. So can you just elaborate more? Like, everyone wants to increase the margin of the business, that we know. But how exactly to decide in which product margin enhancement is to be done? It's just not easy. Like maybe the higher margin product, the business may not be that much happening, but how to bring the balance?
Yeah, it's always a difficult question. But see, there are margins, there are multiple things. The first is, of course, the price that you fetch, like the same ABC class which I mentioned. And are you getting a above average price from the market price or below average price? And So that will first be the first goal to improve the margin, by getting 5 or 10% or 20% more from the customer, that straight away adds to the margin. But obviously it is not so easy, and therefore there are many things that will have to be done to the product. Product re-engineering is one, repackaging is another, going after the more valuable customers may be other, and identifying those customers will be also a strategy. And then of course your sourcing and your own manufacturing, how a product is made and how do you source, are you sourcing efficiently, and do you manage your working capital and your inventory and your manufacturing processes very well. This is the second aspect which goes into the margin. And if you don't have efficient manufacturing processes, then the margins will be low.
Okay. So while you were mentioning this, working capital becomes an important tool here, working capital management, which you also mentioned that while, when CFO is working to enhance the business valuation, a lot of emphasis and checkpoints is given on working capital management. So how does, basically how long does it take to see the impact of the changes done in the working capital management after a business, hire a professional CFO to work on the business strategies and business valuation?
My experience has been that the change starts coming in sometimes as early as 6 months.
Okay.
But sometimes it may take a couple of years, depending on the change that is required. There is a lot of work to be done on the product quality, for example. And it will take at least 12 to 18 months before we start offering better quality products or different type of product offerings in the marketplace. And that itself will have some costs also, in terms of capex or in terms of changing the machineries or whatever else.
So working capital management, you are saying reflection in the outcome will take, maybe it can be as early as 6 months after the, intentional step taking. But it can also go in years to see the change in the working capital management, outcome of the working capital management. Okay.
Sourcing strategy will also have an impact. Sometimes you change your source of raw material. That takes time. You cannot do suddenly. It will affect quality of the product and so on. Exactly. So that also, the change will take a year, maybe 6 months to a year.
Yeah, so depending on what kind of raw material are there.
1 to 2 years as a sort of.
Okay. Vinay, you were also mentioning about the debt equity structures. Now, obviously the debt equity structure is important. But how does a CFO, what is your typical guidance to balance this debt equity structure to enhance the business value?
Let's take a quick break.
Hey, MSME Talk listeners, hope you have not missed subscribing to our newsletter for the latest news, blogs, podcast updates. Check the link in the description. We don't spam your inbox, and hence we do have one of the highest rate of newsletter opening in the industry.
There cannot be a rule of thumb. See, each business is different. How the business operating leverage is, for example, that will derive the financial leverage. Debt equity structure is nothing but financial leverage. You take borrowed money and you repay them, and you pay an interest of whatever 8, 9, 10%.
Right.
And if your earnings are more than that, then you should borrow. But how sustainable are they? That is to be assessed. And therefore, most times the startups, we advise that they should not borrow any money, because there is a lot of risk and uncertainty about cash flows. Once the cash flows become predictable, the customers become predictable, and your margins become predictable, then you start thinking about debt.
Right.
And then you can usually, typically, on an average, you can say 1:1 is a good ratio. And if there is a lot of operating leverage, then I would go for low leverage. There are businesses like paper business, for example. The operating leverage is very high. Then I would recommend a little lower debt compared to the equity.
Okay.
But it needs to be studied. It cannot be a rule of the thumb.
Right. And it's also industry specific, you are saying, and the current status of the company.
Current status.
Right. Vinay, while you have all of these numbers, client, working capital. There are a lot of intangibles in the business. They can be IP, brands, and nowadays a lot of knowledge economy is getting, come into the play and growing. So how does, these assets play a role in startups or SME valuations?
These are very important items. The cash flow is an important tool of valuation, but the sustainability and how a company's image is, firstly, and secondly, the entry barriers that they create are all derived from these intellectual and what we call proprietary assets. They can be a brand, it can be a process, it can be a patent, or it can be anything else. It need not be patent, but it may be just proprietary knowledge which nobody else has.
Yeah.
So that is very critical to value. It's the most important component of a value.
Okay. And nowadays, when brand valuation is done, these things are given proper attention. And is it easy or difficult to do valuation of these particular where numbers cannot be assigned easily? There is a patent or a brand valuation or IP.
It's not very easy. So it cannot be done by just very regular and fresh people,
Okay.
I have nothing against fresh people, but experience counts here. And so the important thing is to focus on the experience and the deep analysis of all these things that we mentioned. We already discussed many things about what are the drivers and how to focus on things like that. So finally, when we talked about, for example, customer A, B, C, the A-class customers will come when either your knowledge or a product offering or your process is very superior, and therefore your brand is superior. Therefore, at the end of the day, brand reflects all of these things, and so only then those type of things will happen, and the margins will automatically reflect those things. So these are then you start looking at these underlying intangible factors which drive the cash flows, which drive your business positions, and therefore it drives the valuation.
Okay.
It's not extremely difficult, but it's not extremely easy also.
So what you basically say that in this particular part of the evaluation, it's just not a number game. Hence, a lot of experience and the industry information and knowledge helps in better valuation, when it's of intangible assets are involved.
There is one other aspect which is not so far mentioned by us, is the disruptive capability. Any new idea also has a lot of disruptive capabilities.
Right.
And it is like a process only in some ways, right? So, for example, Uber, a tech-enabled business, Uber as an example, they started using the tech-enabled product or an app, and it has disrupted the industry. So there is a value to it. And that also can be estimated.
Right. Or maybe for that matter, AI in current environment.
AI is correct.
Right. While you have been talking about customers, working capital, debt equity, intangible assets for the valuation, is there something which is usually doesn't come into the first place, in the first line of analysis? Is there some hidden or some assets or something which is not being used, but as an expert, you are able to, when as a CFO, you're digging into the numbers and the business and everything, you're able to bring out value?
So there will be a lot of hidden things, which can be identified, like idle assets.
Okay.
There are a lot of, many companies have a lot of patents, but they are not using many of them.
Okay.
And the marketing some of the products, they are not making them, they don't know what to do with them, and so on. So at that stage, it has a very low value, but the potential value can be very high. And so value enhancement or unlocking, some of the things comes in the picture. One of the strategies for value enhancement or unlocking can be you license out these patents, or you sell off these assets,
or
you ensure that you do utilize it in some way or other, give it
Okay.
out for rent or lease, for example. There are
Okay.
spare assets and so on.
Got it. So
These are all
basically,
the
you are
things.
saying utilization of idle assets is something a good strategy where you, as a CFO, are able to dig into it and see where is an opportunity lying in the overall business landscape, particular business landscape. Now, could you just share some example of these idle assets which are there's a
As I
possibility
just
of?
said, we have a client who they have 12. I have many such clients in the past, but
Okay,
currently, we have a client who have 12 patents. They
12
are only
assets,
12 patents.
12
Patents.
patents. Okay.
Patents. So these patents, they are using only 2 or 3. The
Oh,
remaining they have filed, they have got it now. They are not able to fully market those products. So we have started a journey where we said, okay, why don't you either increase your production or
hmm.
look at how you can market this to other markets in new geographies, Europe or other markets. And the third option which we are trying to explore is, can they license it out, to some other guy who can use it and then sell, so they can get royalty out of it. So these
Right.
are 2, 3 things which we
And
are
they
trying.
can increase the revenue out of it.
This is not atypical; it is very typical.
Uh-huh.
Because people who focus on technology, knowledge, they keep on filing patents and then it just remains idle. There was another
Okay.
company which had filed 32 patents.
Hmm.
This is in Bangalore.
Okay.
And I was engaged there, and then we tried to see how that can be utilized into multiple verticals and so on. So it was
Okay.
very interesting.
Very nice. Interesting. So Vinay, let's shift our perspective from tech and patent based to non-tech companies. Maybe something like retailers, manufacturers, service providers. What kind of enhancement in the business valuation uh, a strategic CFO can
Yeah.
help with?
So each business has different, each type of business, nature of business has different type of drivers, obviously.
Mm-hmm.
So if we take, for example, retailers, where the key thing is the locations to begin with. Is the location very good? And we have to analyze that very carefully. And second is the footfall. How do you attract the footfall? How do you make it pleasant for the people to come in and move around? So that all, it's a very big art and science. How the people move into the retail malls or shops and are able to shop and so on. And there are a lot of psychological things involved there. So whether that is being used or not, when we do a valuation, then we look at those things and those
So
metrics.
Vinay, what you are trying to say in this case, a lot of these areas, isn't it being expertise of marketing and designers and operations team,
It is.
advertising below the line of BTL and others, or other kind
It
of
is.
team engagements.
It is. Therefore, it is
So
a team effort.
CFO advisory, getting into these things. How does the alignment happen?
So, so CFO, he identifies those gaps to begin with. Like
Okay.
we said, he identifies that, look, you are weak in this area. When we compare you with this particular store, for example, with another store,
Okay.
you are weak in this area. Let us
Okay.
make a program. So they will say,
Okay.
no, but this is difficult. We need this much money. We need this much capex. So then CFO plays a crucial role in not only the numbers, but in developing the strategy, in giving the necessary capital. That look, reallocate your capital from this area to
Okay.
this particular area, and improve your quality, improve your, for example, employee engagement, improve your, asset utilization in terms of space. For example, in the retailer example you gave, how to utilize the space is very important, right? So these things, then the CFO can give the guidance. And then the second part of this is not just you give a guidance, but then you keep measuring it frequently. That have you done
Okay.
this? Has what we had targeted, are we moving towards that goal? And therefore, then the books of accounts and all those things come in the picture. The accounting and other non-accounting parameters. The CFO will give this necessary data and MIS, and then ensure that accountability is taken into account. Fine.
So you have mentioned a very, very important, point here is capital division, okay, or distribution of the capital which is there in the various areas which need capital. That's where the CFO role is coming while taking care of business valuation also in the mind. So very, very apt point. Now, obviously, I was little wondering, if CFO is only going to analyze everything which is other functions does it, then what others are going to do it? And which you said कि नहीं हम अपना view दे देंगे and then let them do it. So, and obviously, being a CFO, you have to also give the check. Now let's understand other, some areas like manufacturer, for example. How would you try to enhance the valuation there?
So again, likewise, similarly how they are structured in terms of their capacity, in terms of their productivity, in terms of their technology. Each of the business will have low tech, medium tech, and high tech. That is my experience, and everything is not the same. Some companies have very high automation, some companies have low automation. So we get into that and then figure out areas of inefficiency, areas, and basic rules are the same. But then for manufacturing, we focus more on such type of other areas, that how is their process efficiencies and so on, product quality, how it is measured, whether they have good standards there and so on.
Okay. So basically, operational part is where more emphasis is given to ensure how valuation gaps are there. There could be a gap which can help in enhancing the valuation. Okay, by increasing the output and the profit margins and the overall earning for the revenue part for the business. Let's understand, does valuation work differently when we are into a M&A situation or buyout situation of founders exits are there, IPOs, maybe through IPOs or through non-IPO of private equity is coming in. Is it same or does it change?
No, there will be differences. The objective, once the objective is defined in an M&A situation, then you look at further factors. Then what benefit will the acquirer get? If you are a seller, or if you are an acquirer, then you will see what benefit you get when you merge two companies or two businesses together. So I'll give you one example. In one case, and can name the company also, Sun Pharma, and many other companies in the pharma business were acquiring another small pharma company. And Sun Pharma gave a quote which was double than all the others.
Okay.
It was double, and they could succeed in acquiring that business. So later on it was found that they had a similar product in their own pipeline. And then when they combined it, they could increase their pricing into the market by at least 25 to 30%. And they recovered this double the price that they paid in 2 to 3 years.
Okay.
So how you see it is called synergy, how whether you are able to create value. And these things have to be analyzed well in advance. And then you can figure out that, okay, if you are a seller, for example, then you can ask for a premium that, look, you are going to get this benefit because of certain things which we have, the seller has. And then therefore you ask for small premium to a normal valuation, that this is your normal, but I am asking you a little higher and so on. So there is a negotiating process then, obviously. And this is an M&A example. In a family situation, again, there are other considerations involved, emotional considerations, how they want to take it forward, and these also things are to be kept in mind when we do a valuation.
Okay.
In an IPO, the marketing comes in the picture. That how can you market this? Value sometimes is when the markets are very high, the value goes up. So can the merchant banker or the people in the broking community, will they be able to sell the stock into the market? And that plays an important part in the value determination.
Timing
and the selling ability, the positioning of the company, the communication.
Narration. So basic thing, timing, narration.
Narration
a lot
perception of the company.
Yeah.
That is built. It doesn't come overnight. Today we may create a nice website or a nice thing. It doesn't mean the investors are taken away by that. They will get into the history of the company. They'll see what has happened in the last 5 years and so on. So that all these things are important, and that will create the perception.
Right. So good reflection now, Vinay. Like business valuation can be enhanced, but depending on the situation, right? of the event, if there's any big event, whether you're looking for merger and acquisition, you want to sell out the business. SME businesses, many, they reach a level where family is not taking ahead. Next generation is not looking forward to take this business and they want to sell the business, or there's an IPO situation. They want to take it to IPO. Business valuation will differ depending on the situation and who is the buyer. Very interesting. And the timing and the narration. So let's understand, Vinay, how to choose the right time to start process of business valuation, and then hiring the CFO services to help a decent enhancement to the business valuation. Now, please tell us in both the aspects, right? One you said is an event driven, another is non-event driven. So how does this work?
So non-event driven will come from the vision and the realization of vision, like you yourself were mentioned, and how the business owner, the predominant owner of the family, will view what they have done so far, or what they are intending to do, and are they anywhere nearer to it, or have they revised those visions and so on. Or if they have never formulated a vision, then it's good time to formulate the vision and look at these aspects, and then evaluate the business from that perspective, whether it is worth it, or what changes they should bring into the business. In case of an event-based, that the valuation process should begin well in advance. For example, in an IPO, at least 2 years in advance. In a mergers and acquisitions also, minimum 2 to 3 years it takes. Sometimes it happens in 6 months to 9 months, but my experience is that it takes at least 2 to 3 years to do sell a business. And so you have to, once the intention starts, the event will come later. But once the intention starts, that look, I need to now consider this, then you start well in advance of at least, let's say, average of 12 to 24 months.
12 to 24 months, right. So in case of event specific, 12 to 24 months at least prior to the event, you are expecting to get into with a professional CFO advisor who can help you into the business valuation, and then filling the gap so that you are able to get higher valuation for your business for the work done for so many years. Can be unlocked properly, because unlocking is required, and who doesn't want higher unlocking, higher valuation for their business. So going into the part where you are saying it's non-event based, it is depending on the vision of the business owner, how they want to see the growth of the business and what steps they want to take it, how much passionate they are about and serious about to bring out the growth and to bring a direction to that growth.
While in startup, every founder wants to enhance the business valuation. But if we go to the other segment, which is SME companies, majority are not even giving any thought to know the business valuation of their businesses. So what guidance would you like to give to SME with this aspect?
My personal advice would be to, it's like a health check. If you're doing nowadays everybody is doing annual health check, every 6 months. Likewise, once a year at least, we must do a business valuation and take advice from experts. They should think of it like a health diagnostic, a business diagnostic like that, likewise. So nowadays everybody is health conscious. People do their blood test and other tests every year and go for a treadmill and things like that to check their heart and sugar and everything else. So likewise, a business should do evaluation every year, and as soon as the balance sheet is out, people pay their income tax. Likewise, this is another small effort every entrepreneur should make to find out that how their business performed, not just in profit, because the P&L, the profit and loss and balance sheet will show a number that I performed a little better than last year, but what is the quality? That will come out of the valuation exercise. Have they improved their quality? Have they improved their value? Have they improved their sustainability? What can be done further? Was it enough compared to the market?
So basically you are saying consider business valuation exercise as a health checkup. So it's just not, auditing of your business, financials. Just don't rely only on that part. extended to the business valuation exercise, which can give you in areas where need to be given attention to, so that your business valuation, the growth of the business is at a pace which it should be. And specifically for the business owners who are focused and who are looking forward to grow their businesses higher. Thank you. Thank you, Vinay, so much for joining MSME Talk expert ecosystem and telling our listeners an important aspect of growing their businesses of business valuation. We'll see you around again in any other specific topic of your expertise or your company's expertise. Dear listeners, since last 3 years, you have been listening to MSME Talk audio podcast on Apple, Spotify, Amazon, etc. Now it is available in video format on YouTube as well. Also, I would like to tell that more information and updates are not covered on podcast, for which you have to ensure that you subscribe our newsletter and follow us on social media. Links are given in description. Happy to share MSME Talk podcast enters peak ranking chart of 10th country in the Apple Podcast country level entrepreneurship category. If you are an expert or provide product or services to small businesses, MSMEs and startups, reach out to us to discuss showcase opportunity in MSME Talk. Contact details given in description.